Well, welcome everyone to SilverOak's quarterly webinar. My name is Shannon King, and I am President, Partner, and Chief Compliance Officer for SilverOak. And as usual, joining me today is Jonathan Charlo, also a partner of the firm and our lead analyst. In today's webinar, we will be discussing the overall markets and economy. And in doing so, we'll be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. With regards to today's webinar, they're typically 45 to 60 minutes in length. I suspect we may be on a little bit shorter side of that, maybe around the 45 to 50 minute side based on the materials. If you have any questions throughout today's webinar, we encourage you to reach out to your SilverOak advisor. If you're not working with a SilverOak advisor, you can contact me directly at 952-896-5701. Also, for today, we will not be discussing specific SilverOak portfolio performance, as each of our clients' portfolios are customized. Nonetheless, all of our clients should have received their customized performance reports within the last week or so. If you have any questions on those reports, again, feel free to contact your SilverOak advisor if they have not already contacted you. And lastly, past performance is no guarantee of future success. So with that, Jonathan, let's take a look at today's agenda. And where are we going to start today?
We're going to go over the economy and the SilverOak dashboard as usual.
Okay.
We'll talk about market performance, trends that we saw in the second quarter and on a year-to-date basis. We'll provide an outlook both for the economy and the investments, and provide some updates on SilverOak, our IQ's funds, things like that. And then, as usual, we typically choose another topic. And today we're going to review identity theft best practices, because certainly this is something that is becoming more and more prevalent.
Yes. And I would say even within the last month, we've had a number of clients have various identity theft issues. To say
right, and in preparing for it's both kind of old-fashioned types where it's not on the computer, and then kind of the cyber issues that we're dealing with.
And of course, if you have any questions throughout today's webinar, as I mentioned, reach out to your SilverOak advisor. And I would also ask that if you have topics that you would like us to cover in a future webinar, certainly let us know of those topics as well. So let's start with the economy and SilverOak's dashboard. By now, many folks on the webinar probably are familiar with our dashboard. It is made up of four major components, the first of which is the economy. And essentially what we're showing in each of the columns are different quarters going back to the third quarter of 2020, and then projecting ahead on the right side to the fourth quarter of 2023. If the box is shaded red, that is typically considered negative. If it's a gray shade, that's more neutral, and green is positive. So here we can see from an economy perspective, the second quarter came in negative, as we were projecting in prior webinars. And we anticipate may stay negative for another quarter, and then hopefully transition to at least more neutral, and maybe further on into the more positive category. And we'll talk about what makes that up in a few minutes. As far as the credit markets go, they remained in the neutral category and look to remain there for the next quarter or two. Now, the one that did shift is valuations. And I know, Jonathan, you're going to touch a little bit more on that in a few minutes, but what did we see with valuations, big picture, that caused it to go negative?
Basically, prices in the market went up, whereas earnings did not go up. And so as a result, valuations expanded, and as a result became negative. We were actually projecting for this quarter that they would be neutral. But again, this is because the market was up.
Okay. And then the last of the four major components of the dashboard, market sentiment, and that actually shifted in the other direction, probably though closely related to the fact that markets went up.
Markets went up. As a result, valuations were negative. Market sentiment's positive.
Exactly. So if we put those four components together, we get our composite, which does remain in the negative category. However, I should point that although still negative, it is starting to trend up. And so that's a good sign. Hopefully that's an indicator that things are getting better and that trend will continue. Now, nobody really knows for sure, but we're hoping that upward trend continues and we've experienced the trough. At some point, we would anticipate that we will cross over that red line, the horizontal red line, to a point in which we get back into more favorable positive territory. So with that, Jonathan, let's break down a couple items within each of the dashboard components. And maybe we'll start with the economy and the ISM manufacturing index.
Yeah, absolutely. So manufacturing has been weak in the last year. And so what we're seeing with the downward arrow is that essentially it peaked back in 2021, has been coming down. It has broached that red line, which in the past did predict recessions. And so certainly the potential for a recession is there. It's been widely talked about. And one of the things we'll talk about later is it's not here yet.
Yes. How about unemployment? Another important component of the economy. Maybe a brighter point too.
It has been brighter. With slowing growth and with interest rates going up, it has really been projected that the unemployment rate would go up. And we can see kind of in the bottom part of the page that it's been kind of up and down, but no real trend for an increase. Now, that's not to say that that couldn't happen as we go through the year, but it has been persistent. And the economy, as a result, has been a bit stronger than people would have expected. And when I mean stronger, not as weak as people thought it would be.
Well, and we'll talk about really what this ties so importantly into, and that's the consumer and consumer spending, because consumer spending does drive 2/3 of the economy. And a lot of that spending either happens or doesn't happen based on whether you have a job or not.
Correct. Correct.
So let's go into housing, because that also is a big component of the economy.
Yeah, so with rising interest rates, we've seen mortgage rates skyrocket in the last year. And as a result, we've seen housing starts go down. Now, this last month or two, we've actually seen them tick up a little bit. Now, we don't know whether that's a trend, but one of the issues is that we've seen housing starts kind of maybe at least level off, whereas we've seen existing home sales continue to be weak. And it's hard to know exactly the reason, but it is possible that the home building companies are offering below market mortgage rates, and that might have spurred a little bit of demand recently. But again, it has to do with the consumer. The consumer has remained stronger than expected. It's not to say that it isn't weakening, it just hasn't weakened as much. So we're going to certainly want to look at housing starts because it is and housing is a big part of what's going on in the economy with inflation and the potential with where consumers really are.
Sure. So that kind of summarizes a couple of the subcomponents of the economy. Let's talk about credit markets and what are we seeing in that component of the dashboard.
Now, as you remember, credit markets in the dashboard are gray or neutral. The yield curve we have shown in multiple webinars, and this is definitely a negative factor. Short-term yields are higher than long-term yields, hence it's inverted. And this has been a good indicator in the past for recessions. And again, we've talked about how everyone's expecting a recession, has expected it to start or will start. And certainly this is one of the indicators that people are looking at when they make that prediction.
And right along that same kind of tone is spreads.
Yeah, and this is one where it's been a little bit more positive than people have expected. We've really talked about with a slowing economy and with the Fed raising interest rates that we should see these spreads actually widen. Now, in the past in recessions, we've definitely seen these yields blow out. Now,
and what we're looking at here, just not to interrupt, but
yep.
The real important component here is to look at that black line. And as the black line goes up, that's indicating what you just mentioned, that the spreads widen, kind of blow out when it spikes.
Right.
But that black line stayed relatively low.
Yeah, and that's that little circle right at the end. And with the upward arrow, we're just indicating that in a recession, you would typically see these yields increase significantly. And the three other bigger circles kind of show in other recessions how high they went.
Good point. So you mentioned valuations. Touch a little bit more on valuations and corporate earnings.
So valuations have gone up because the market has gone up. At the same time, earnings for 2023 started last fall with growth expected, and we've actually seen that ratchet down such that we kind of have negative expectations on a year-over-year basis. Q1 was a little bit better. Q2, we're still early in that, but the projections are that Q3 earnings estimates will probably come down. Then the question mark is really where we are in the fourth quarter. But that's really where we're at. So certainly it's been a negative to neutral factor while the market has been up. And so as a result, valuations are higher.
And to your point, as valuations are higher and particularly driven off of prices going up, that's been a good correlating factor to sentiment. People are feeling good.
Absolutely. So when we look at the dashboard, the most positive input is the market itself. And back in the first quarter in our webinar, we talked about how this green line, the 50-day moving average, by going through that orangish line, that was actually very positive. And basically, we've seen that kind of expand. Now, in February, the market did pull back with the banking situation, but has honestly come roaring back. We'll talk about this later, but we have definitely seen technology stocks do very, very well this year, and especially in the second quarter.
Well, I think that's a good transition into what we've seen in the markets. And although we don't have it titled here, other than just the generic market performance, I would label the quarter or maybe even the year more so as equity returns surprise, because I know when I'm sitting down with clients, I don't think coming into the discussion they really have an understanding or appreciation for how strong the equity markets have been this year. I think a lot of people are still grounded in last year's.
No, I know, because it was really bad, and
Yeah.
This year has been really good, and it's just a weird situation. And we know that the market is forward looking, but I think maybe the surprise might be how well growth has done this year, and we'll talk about that as we go through performance. But even that's been driven by, a handful of large tech
Right.
companies.
Right. So if we look at market performance, we can see here for the second quarter, all of the equity markets were positive. Obviously, US large cap and international were the two kind of standouts. But again, all of them were positive. As we look on a year-to-date basis, even more so. And the year-to-date up 16%, we have to put that in perspective. That's literally 6 months of data, which seems obvious, but if you annualize that, we could be looking at performance well in excess of what we saw in 2019 or 2020 or 2021, which were all just phenomenal years. The other thing I'll point out is the NASDAQ, which is kind of growth-oriented, technology weighted. It had the best 6-month start of a year this year versus the last 40. And the S&P, I believe it's the best 6 months over the last 5 years or so. So maybe not quite as impressive, but still pretty darn good considering.
Yeah, and to put it in perspective, NASDAQ as of June 30th was up more than 30% for the year. But when we look at the Dow, which has more manufacturers and industrial companies, good, it was up about 5%. So that's that gap that we've definitely seen.
And we'll talk more about that in a few minutes. So as we look at the other components of the markets, bonds, commodities, and REITs, you'll see on this slide, most of them are slightly negative. Commodities maybe a little bit more than slight for the quarter. On a year-to-date basis, obviously commodities down a bit more, but all of the other categories now in positive territory on a year-to-date basis. And we'll talk about what happened in the fixed income or bond market in a little bit more depth in a few minutes. So let's touch on what you had just made reference to, Jonathan, growth leading again. And I would say that's growth versus the other side would be value oriented.
Yeah, so both for the second quarter and year to date, when we look at large caps, growth has done better than value. And we're not showing the 1-year number, but essentially during that period, value did slightly beat growth. We'll go through the economic sectors in another slide, but a lot of that had to do with where value had done better during that early period in that 1-year rolling number.
And maybe I should step back. For anybody that's new on the webinar, they may not be particularly familiar with large, mid, small, or what growth and value really mean. We touched on it a little bit, but large cap just simply means big companies. It's, the big ones that most of us are pretty familiar with their names. Obviously, mid cap then goes into the smaller companies, and small cap are the smallest. You probably name 100, and most people wouldn't recognize half of them. And value versus growth, Jonathan, you just made a little bit of reference to it, but growth being more tech oriented, value being more manufacturing or financials, things of that nature. So what you had just explained in large cap, is that true?
Yeah,
mid cap?
So essentially very similar trends in mid, where we saw growth do better than value during both periods.
Okay, and it looks like the same in small cap as well.
Yeah, absolutely.
So really what's driving this recent surge in growth?
Well, when we look at growth, one of the things I think we can look at, and growth would be on the bottom half of the slide, is we're looking at really pretty high returns. So communication services up 13%, consumer discretionary up 15% in the quarter, technology up 9%. Okay, but the other side is when we look in the value side on the upper half, we see some zeros, we see a -1, and we see kind of low single-digit returns. That's the difference in the second quarter. But also the growth area is just so much more concentrated. We only have 4 industry groups, whereas when we look at value, we have many more. And then here, when we're looking at it on a year-to-date basis, this just becomes obvious. You know, communication services, discretionary technology, all up more than 30%. Whereas in the same period, energy, utilities, and industrials are showing negative returns.
And really, when we look at that growth category, it's not necessarily even broad-based. On this next slide we'll see the concentration even within the growth has made a huge difference in performance.
Yeah, so here we're looking at the biggest names within the S&P 500. And so here we're showing 6 technology companies. There's been this term, the Magnificent Seven, talked about. That would actually include ExxonMobil. But here we're just showing you those top 6 tech companies. And so the overall return for the S&P, you know, was up almost 17%. Those 6 tech names actually contributed more to that return than the rest of the S&P 500, which actually had a slightly negative contribution.
Now, we have seen more recently in the last few weeks a little bit broader performance. Whether that will continue or not,
correct. We've seen value do a little bit better. We've even seen small cap tech do a little bit better. Now, after yesterday with Tesla and Netflix, we'll see whether that continues.
Sure.
But that's absolutely right. We've seen it broaden a little bit. And here's just another way to show how the market performance has been so narrow. So the blue line is the top 10 companies, and the greenish line would be the next 490. And so performance really through much of the first quarter was pretty close. But that really expanded and quite frankly, really happened during the second quarter.
So thus far, we've talked a lot about more U.S. oriented positions. You know, this is obviously the S&P 500, which is U.S. Dominated. What about the international markets? What have we seen there?
It's been more of a mixed situation. If we look at Q2 returns, and on the far left, we see China's down about 10%. Kind of in the middle, Latin America is up about 14%. And then if we look to the right side, we're looking at developed markets, which are generally positive. Now, Japan has actually had pretty good performance. Now, very similar trends than when we look at it on a year-to-date basis. But I think the other thing that really pops out on the right side of the slide is that the developed markets have generally done better than certainly emerging Asia and China. You know, China's dealing with kind of the reopening and that initial excitement in the first quarter, and then things have kind of slowed since then. Now, Latin America is kind of an interesting one with commodity prices down. There are a handful of stocks that have done very well within that region, including some technology companies, believe it or not.
I actually find the returns in Japan pretty astonishing, given we've come off of such a long period of time where Japan just really hadn't done a lot.
Yeah, it is really a change from what we've seen in the last 5, 6, 7 years.
And I did mention that we'll touch on bonds. So talk about what impacted bonds, particularly the second quarter and then maybe year to date.
So in the second quarter, I think the biggest factor really was we saw interest rates go up. We saw short-term rates go up, and that was really factored by the Fed providing communication that there are likely 2 more rate hikes. And then I think actually the labor market statistics being stronger caused rates to go up, because the bond market was essentially factoring in that this recent strength would maybe respur inflation, keep the Fed active in rate hikes. And so we're generally seeing those negative returns. Now, emerging markets and high yield really comes back to that slide where we showed the credit spreads weren't widening. So they stayed in place and they have higher yields. And so they actually had fairly positive returns. And so when we look year to date, you know, again, very similar patterns, although we're looking at positive returns.
Excellent. Well, thank you for the summary of the markets. Now let's turn our attention to SilverOak's outlook. As we look at the economy itself, we believe inflation will continue to moderate, but still remain above the Fed's target, which will likely contribute to the Fed continuing to act. And you made reference to that just a few seconds ago there. And I think the markets pretty much have pretty much resigned themselves to a guaranteed rate hike in July, maybe one after that, and then maybe a third. We'll see. That's the real what if.
Correct. Yeah, and that, you know, when they meet again and raise in July, if they communicate a third rate hike, that would be a surprise. It would be perceived negatively.
Sure. And at this point, it's a toss of the coin, recession or not.
Yeah, I mean, we've been talking about a potential recession now, it seems like for a year, and a lot of the recent data points maybe suggest a soft landing, or this kind of other term we've heard, kind of a rolling recession. More interest rate sensitive industries maybe have already been in a recession. And then we've talked about the consumer, because the consumer is, you know, 70% of the economy, and it's been persistently stronger than people have thought. But in the second half of the year, if the consumer completely rolls over, perhaps that actually could lead us into a mild recession.
Right. And I mean, I just have a hard time, you know, after looking at some of the slides that we looked at earlier with the ISM manufacturing and the inverted yield curve and just a number of factors that have just been so not perfect by any means. Nothing's perfect, but they have been relatively good at forecasting recessions, yet we just still have not seen it. As far as the international, economies go, probably central banks worldwide, with the exception of Japan, they are not raising interest rates. But I would think that for the most part, all the other countries and central banks are doing so. Europe certainly has slowed, but we're at this time anyway thinking a deep recession is not in the cards. And then of course I just mentioned, or I guess I mentioned Japan. China on the other side is having its own problems, which is contributed to the emerging market, particularly Asian emerging market returns being pretty unimpressive, particularly against the US.
Yeah, absolutely. And so likely that will cause China to provide some stimulus, try to restart their economic growth.
Sure. All right, well, let's talk about inflation, because this is obviously at the top of the Fed's concerns, and whether they can get inflation tamped down and keep it tamped down.
Yeah, so absolutely. So really since the peak of last June, we've seen inflation come down. The blue line would be headline inflation. That's come down, again, still above the Fed target, but now approaching kind of the 50-year average. Now, on another side, we'll talk about this a little more, but there's a difference between core CPI and the headline CPI, and the core is really the issue that the Fed is looking at.
Right, and just to make clarification too, you mentioned the 50-year average, that's the dotted line, but the Fed target is actually 2.
Correct.
Which is quite a bit below even that dotted line. So even though the blue line looks like it's coming close, or the black line even, I think that's black anyway, somewhat close to the dotted line is actually above the Fed's target.
Right, and as we had kind of mentioned, the viewpoint is, well, it's coming down. We're not going to hit the Fed target likely until the end of next year.
If then, I
then.
think they're even projecting maybe past that.
Right. So to kind of provide, that, here on the top with that circle, couple things. The circle is again showing that difference between the headline CPI at 4.1%, whereas the core is in the 5s. But you can also see that you're seeing some yellows and greens, which means that it's cooling. Now, the reason that we're seeing a difference between the core and the headline has a lot to do down right at the bottom, these core services, which a lot of that is shelter. And so in the middle in 2022, you can see the reds and the oranges, and then right at the end, you can now see more yellows and maybe some emerging greens. So the shelter inputs are cooling. Now we're coming up against big numbers from last year. So those are likely to cool still, which is really why, there's somewhat of a comfort level that will continue through this year of seeing it cool a little bit more.
Mm-hmm. Now we've talked a little bit about recessions, maybe even a lot about recessions, and is it going to happen? Is it not going to happen? Some people said, oh, well, maybe we are in a recession. You mentioned rolling recessions, but recessions are really called by the National Bureau of Economic Research. And what are they seeing based on their measures?
Yeah, so basically for them to call it a recession, this is right from their website, it requires a significant decline in economic activity that is spread across the economy and lasts more than a few months. And so they look at these 6 categories that we show on the bottom. And right now, we only have 2 that are actually negative. Now, if we look at some of the others, we're looking at non-farm payrolls, maybe employment weakens and that comes down. We're looking at household survey employment, again, employment could weaken, but it still comes down to this real consumer spending, which has been slowing. But if that continues to come down, if those 3 things come down and go negative, maybe they do call it, right? But so far we're not even close to their definition.
Well, let's touch on the state of the consumer, because as I mentioned earlier, the consumer is so important as it relates to the economy and recessions. I mean, it's almost impossible to go into a full-blown recession with the consumer still healthy and spending. It really requires typically the consumer to pull back for us to fall into a full-blown recession. So here on this chart, we're showing that the savings is coming down. Obviously that blue shaded area, that is a bunch of stimulus money.
Correct. Yep. And I think it might have been Jeremy Siegel maybe a week ago, talked about how YOLO spending is going to go away.
Mm-hmm.
You only live once. And part of what he's getting at is that this stimulus money, that peaked at over $2 trillion is now under $1 trillion.
Yeah. And then related to that is credit.
Yep.
That has increased.
Yeah, so basically credit card debt, because of the stimulus, went even lower during the pandemic. And what we've seen in the last year is that's come roaring right back, maybe to pre-pandemic levels. And then on the left, we're looking at the overall savings rate, which has also come down.
This next slide, though, I still find fascinating. Because what you're saying here, Jonathan, is that the household financial burden, so how much they're spending as a ratio on servicing debt, although has ticked up over the last year or two, it's still relatively low based on history.
Yeah, absolutely. And when you look at that circle, we're looking at mortgage debt service today versus where it was back in 2007. And in 2007, we were dealing with 7% mortgage rates. Today, obviously they're very close, but so many people refinanced during the pandemic at low rates. That I think is part of what we're looking at.
Part of why existing home sales aren't great, because why do I want to give up my 3% mortgage for
Right.
a 6 or 7% mortgage?
Yeah, absolutely.
With regards to interest rates, this is basically right from the Fed. This is their projections. Well, it's the historical rates plus the projected rates on where they think the Fed funds rate will be going forward. And to your point, they're not projecting out getting back down to their 2% target anytime soon.
Right. And it's probably hard to believe that, interest rates as we go through the next couple of years should come down. But that really is what we see historically once the Fed funds rate starts to come down.
And just looking back, and I almost hesitate to mention this, but looking back last year, and I hate to mention it because it was just such an ugly year in the markets, both equities and bonds. But if you look at this chart and what happened with the Fed funds rate from 2000, let's say 21, late 21 into early 22, and how the Fed rate just skyrocketed in such a short period of time. So very extreme with short duration. That tells the whole story on why the bond market actually had a tough year last year too, because rates, they didn't just gradually go up over some long period of time. They went up a lot over a very truncated period. So what do we think will be happening as we look forward rather than looking backwards? As equities are concerned, we still do believe it's possible volatility can increase. And the type of volatility most of our clients and investors are worried about is not the volatility we've seen the last 6 months, which is the upside volatility. It's the downside volatility. And nobody really knows for sure, is the market going down, is the market going up? But I think we could expect more volatility in both directions. You mentioned earnings growth probably going to slow.
Yeah, but the other side, and we'll show this, is that the market is expecting earnings to rebound next year.
Markets are really obviously pricing in some increases in the Fed funds rate, but they're also expecting that at some point the Fed will begin to pivot.
Yep, absolutely.
And maybe it's a higher for longer, so they don't pivot right away, but we would anticipate a pivot at some point. We talked about valuations. We talked about US large cap stocks doing so well. And typically when something has such strong performance, maybe you want to look elsewhere to see if there's better valuations and opportunities. And you've outlined here potentially in international markets, maybe small cap, and frankly, maybe even in some large caps that are outside of those 6 or 7 stocks.
Yeah, absolutely. Yeah, absolutely. And as you mentioned, with a pickup in volatility, which could provide maybe a pullback, just wanted to mention that is actually pretty normal in a given year. And that doesn't necessarily mean that the market is heading back to the lows of last year.
That's a good point. I mean, we've shown before some slides, and maybe next time we should include them again, how often 10% pullbacks occur. I mean, they're very typical. Even 15% aren't all that unusual. Most people don't even know they happen though, because by the end of the year, the market has recovered. So if you look, oh, the market's up 10% this year, but you didn't realize maybe once, maybe twice along the way, it was actually down 10% too. And then of course that gets to the whole point of diversification. It continues to be exceptionally important, especially in markets like we're in.
So here we said we'd talk a little bit about earnings, and so earnings estimates have been going down for this year, and that's really when you look at EM, developed markets, and the U.S. That's kind of across the board. But as you can see in the circle, that we're kind of flattening out a bit, and certainly when we look at the diamonds, the expectation is that forward earnings will actually increase a little bit and show some modest growth for next year.
Hence, our growth expectations here for earnings.
Yeah, I mean, this is where we're at right now, but the blue line is for 2024, and the green line is kind of where we're at for 2023. Right now, the expectation is that earnings for the full year this year will be down 3%. Now, they did start originally at almost up 10%, and so we've seen that decline. The blue line, though, is the expectation for next year, which is an 11%, and so likely that will come down, but I think we're looking at likely slightly positive numbers, maybe more in the line of what we saw on the prior slide of kind of in that 4, 5, or 6% level.
Sure. And then one more touch on valuations.
Yeah, so again, valuation isn't cheap, but on the green, on the top, that would be the top 10 stocks. And so as we saw in the second quarter, valuations in those big stocks really expanded. The black on the bottom is really the kind of the remaining stocks, and they went up, but just not as much. And so what I mean by stocks not being really cheap, if you look at the top 10, they're almost 150% above kind of the average valuation multiple. The remaining stocks are only about 113%. So not cheap, but certainly not as expensive.
Sure. Now, I mentioned at the beginning of today's webinar the statistic on the first 6 months this year being so positive. Why does that really matter?
Well, again, on this slide, we're showing the difference between markets where the first 6 months are negative versus the years in which they're positive. And so you get a higher return within that. And I think that just comes back to maybe the momentum aspect in the markets that we see over time. You know, people go in because things look better.
Sure. And then lastly, on equities and kind of what we're expecting as we move forward, this is showing the international stock performance, at least in the circle, from all of 2022 through May of this year. And then off to the side, to the right of that, are the US returns for that same period of time. And we're just showing here, Jonathan, that although both are down, international is down less, hence it's outperformed the US.
Right. And in the last webinar, we did kind of show another slide suggesting that maybe we're at the beginning of an international cycle, and there's some reasons for it, but we're actually seeing that in the returns. And so interestingly, if you look at the S&P year to date, it is doing better than international. But if you actually take out those 6 tech stocks and look at it on a more even weight basis, international is actually doing a little bit better than the other stocks within the S&P. So again, probably early days, but the international cycle might be turning.
Sure. Well, with that, let's turn our attention to the outlook on bonds. And we do anticipate yields, at least short-term yields, hopefully are likely peaking, if they haven't, getting close nonetheless. But valuations here provide a much more favorable risk reward than maybe we've seen in, I don't know, 5, 10 years.
Right, because yields are relatively high now, certainly compared to what we saw in the last 10-year period. And at the same time, the Fed will be done, and at some point we will see interest rates begin to fall. And then from a total return standpoint, we'll see better returns from bonds.
And the next bullet point I find interesting in that this is one area that we've seen a pretty dramatic shift of recommendation. If we look back, I don't know, 2 years ago or 3 years ago, where we tended to be maybe a little bit more shorter duration. Now we're saying maybe longer duration is the place to be.
Right, so you get that total return, you get the yield plus the price recovery as interest rates start their downward path.
Yes. All right, and then of course, we know spreads could widen, particularly on high yield or low quality type positions. So we would still stick with higher quality bonds, but again, maybe going out further on the duration side of it. And this is something, Jonathan, that I know we have discussions with clients a lot about these days. Because, you know, if you go out and buy a T-bill at 4.5% or 5%, that just seems like such a sure thing. But we're counseling our clients to be careful of that. Why? What's wrong with that?
Because essentially, you're not, when you make that decision, you're basing that certainty because you've experienced loss. But there is that other side, which is interest rates will come down. And in doing so, you get that total return of the yield plus some price appreciation. And it's tough for people to see that coming. But here we're looking at past cycles going back to 1994. And in the 12 months following the last Fed rate hike, and again, could be July, could be September, but we're getting very close to that. And so looking forward, and this again is that risk reward, that it's very favorable by going into bond funds. Mm-hmm. And the returns can be higher.
Sure. All right, well, with that, we're going to wrap up our discussion on the economy and the markets, on our forward expectations, and touch on SilverOak updates. So let's touch briefly on our IQs, our investment quality scoring system.
Yeah, so our growth investments have done better than value this year on an absolute and relative basis, but I will remind you that growth did horribly last year.
Right.
And our value funds generally did well.
And when you say growth, just to be clear, not necessarily our growth funds did horribly on a relative basis, just all growth
funds. Yep.
Did horrible.
Yep. And generally, when we look at returns, they've been strongest from large down to small, kind of in that sort of order. And again, largely because the bigger tech companies, you know, by definition are in large caps. But when we look at small caps, they have more financials, energy, and healthcare, which, you know, some of those have had negative returns. That's really kind of what we're looking at. Now, in our international funds, we've seen some really good performance. I'd say our international value has actually kept pace with the international growth. And then one of the things I also say is our international small cap investments have had a nice rebound. And one of our emerging market investments has had a very strong rebound this year. And in general, our emerging markets have done better than the overall market. When we looked at, you know, fixed income, you know, everything got hit last year. There wasn't as much differentiation. We're starting to see that come back. I will say that our fixed income funds are well positioned once interest rates start to come down. And so I do think we'll see, you know, some nice returns over the next couple of years.
Good. As far as other updates, we have added 2 new team members to SilverOak, so want to welcome them, and certainly happy to have them on our team. As a result, though, There will be some transitioning of roles and responsibilities, I suspect, over the next 3 to 6 months. As meetings are getting scheduled with our clients and such, you may be hearing from a new person or two. Of course, we'll do formal introductions along the way, but just to be mindful of that. And then we have a couple of new white papers that are shortly going to be issued. One on international investing, the role of cash we just touched on, talk a little bit about inflation in one of our white papers. Actually, I think come Monday or Tuesday, we're going to release the Minnesota tax update white paper. And then we also have a refresh of our identity theft white paper, which really brings us into the last topic for today, and that is identity theft best practices. And before we talk about those best practices, I thought it'd be important to just talk about the common threats that we're seeing. And there's a number of them. I mean, there's phone scams. This is actually an example of something that's happened in the last month to one of our clients, where they thought they were talking to tech support, but it ended up not being tech support. We've had over the last couple of years, clients get impacted by getting a phone call from a grandchild or a family member saying that they need money. Or of course, the common one is somebody gets a phone call from the IRS or from a representative, supposedly from the Social Security Administration. There's a number of cyber scams out there. I think these are the ones most people are really familiar with. But unfortunately, these scams are successful. That's why they've been around for decades and probably will be for the next decade or two. Ones people don't think as much about, but mail scams. People grabbing mail out of your mailbox and whitewashing checks, or even wire scams. When you go to a home closing, are you wiring or sending the money to the right place? It'd be a shame you transfer over however many hundreds of thousands of dollars thinking that you're buying this home and it ends up somewhere else. Or even getting email requests that are going to various financial institutions from folks that are pretending to be you. And this is only, a handful or so. There's a number of threats that are out there. So what are the best practices? Well, I would say as it relates to phone scams, don't give your personal data to anyone that's calling you. You don't know, are they legit, not legit? For loved ones calling you saying they need money, I always say, ask questions that are so specific, only that one person would know. If you really, really want to be comfortable, like, maybe if my daughter called me for money, or maybe I don't want to pick on my daughters, maybe my son as well. I ask questions, and here's a real trick. Ask questions maybe they can't even answer, then you don't have to give them the money.
Yeah, my mom got a call, and supposedly our son was calling her to get out of jail.
Oh.
And she said to him, well, you need to call your father about that.
Yeah, there you go. Cyber scams, of course, do the obvious. Keep up-to-date firewall and antivirus software. Use strong passwords. That's probably the number one. Use strong passwords and change them often. Convert over to multi-factor authentication. We have some clients that actually keep separate emails for different purposes. All of their financial transactions are through one email, and more their personal through a separate. Use VPNs, and this is like the most obvious, but I can't tell you how many times people get impacted by clicking on attachments or links that they haven't verified. And that's why many times our clients will get phone calls from us. I'll get an email from a client. I know it's probably totally legit, but it wasn't something I really maybe wasn't totally expecting at that time. I'll call the client and just say, hey, got this email, it's got an attachment, just want to make sure it's legit. Okay. Mail scams, hold your mail when you're out of town. Maybe even sign up for informed delivery. Great service. There you'll get an email telling you what mail was delivered to your house that day. And if you are expecting a tax refund check and it says it's in your mailbox, but you get home that night and it's not, you might have a problem. Or wire scams, independently verify wiring instructions. Make sure your financial institution has policies in place to mitigate fraudulent wires. Here at SilverOak, whenever we get a request for a wire, our last step in our process is to call and verbally confirm that wire with the client. And many times we know if you send us an email, probably totally legit email, we send you the paperwork back to sign it, and we get it back via email. That's all, 99.9% of the time it's fine. But there's that last step that we go through in a verbal verification. I know it is annoying to some folks that are busy and traveling and such, but it's so important. And then other best practices, probably one of the ones I'll point out here without going through all of them, is when you're out of town, don't be posting that you're out of town. I mean,
yeah, probably it's fun to post your vacation pics, but probably you shouldn't.
At least not until you get back
Until
in
you
town.
get back into town, correct. Yep.
Or don't post things that are obviously relative to passwords and security questions, like, oh, here's the high school I went to, when you're using what's the name of the high school as a
Right.
security question.
Right.
I mean, just, put two and two together and think about those types of things. And then, of course, a lot of these are pretty obvious, but it's sometimes the most obvious ones that get people in trouble. They just drop their guard and, hey, they throw away that statement in the garbage can. Oh, it's not going to be a problem this time, without shredding it. If you are a victim, obviously act quick. Place fraud alerts at the credit reporting agencies. Freeze your credit if it's not frozen. Maybe you need to set up new bank accounts. Certainly contact financial institutions, file the appropriate reports. Consider maybe even getting an IRS IP PIN so that nobody can file a tax return fraudulently on your behalf. Okay, these are all things that I would highly recommend you do, or at least consider doing, and consider it quickly, because time is usually of the essence in these circumstances. And remember, the IRS, the Social Security Administration, and probably every other government agency, they are not going to call you, at least not initially, right? They're going to first communicate with you via some type of written communication, right? And they never demand immediate payment, or they'll never threaten you. Say you're going to go to jail if you don't pay this by a certain time. I mean, these things, again, just seem so obvious, but at the heat of the moment, and you're on the phone and somebody says they're going to turn you into the police, that can be very emotional, and you maybe make a decision that's not
And I would say, even besides government agencies, your bank isn't going to call you and tell you that you're going to get arrested. And another one that I heard recently from a client, and this is when he knew that it was fraud, was when they told him to protect his bank account, he needed to buy Bitcoin.
Yes.
So they're not going to ask you for Bitcoin either.
Yes. So. Yeah. So just keep an eye out on these particular scams. And as I mentioned, we'll have a white paper, a refresh of our white paper coming out here very shortly. So with that, if you have any additional questions, reach out to your SilverOak advisor. We encourage you to reach out with any additional topics for future webinars as well. And if you're not working with a SilverOak advisor and you want to contact us, you can contact me directly at the 952-896-5701 number. With that, thank you to our entire team for putting the materials together for today, and for our technical folks that made all of this happen so seamlessly. And for everybody that was on the webinar, we thank you and wish you a great afternoon.